In this video, Tom Lee analyzes the current market landscape, emphasizing the influence of inflation expectations, tariff talks, and a significant tax proposal from Republicans. He notes that a trend of market volatility, with Friday's drop potentially leading to panic Mondays, and pointed out a disparity in the inflation views between political parties. Despite these challenges, Tom believes the market has shown resilience, suggesting that tariffs have had limited negative impact and have often created buying opportunities.
Sort of take a hit on Fridays and maybe panic Monday, so I don't know if that's going to be the case. To me, I think the inflation headlines from UMich they're not great to see, but also I think that they are messed, or there's a political component to this, because if you break that down between Democrats who see 5% inflation and Republicans at zero, the blend is actually pushing this number up. But to me, it just gets messy around elections.
Yeah, but I mean, let's be honest. There are broad concerns about parts of this agenda from this White House, including, I might add, from the Fed, that it could be inflationary when rates are already more elevated than I think the Fed would like to see. They'd like to be able to cut more, but their hands are tied. And one of the reasons their hands are tied because of tariffs and unknowns about inflation. Fair?
That's fair. I'm not sure the UMich survey reflects their assessment necessarily of the tariffs as much as, let's say, the bond market. And the bond market seems less concerned about it because, as you know, yields have backed off from 4.8 towards 4.5. But you're right. Tariffs are a reason to be uncertain. But so far, I think if I looked at how markets reacted, I think they've actually taken them in stride.
I mean, your biggest takeaway thus far, you say, is that the market's proving resilient, which, I mean, let's be honest, too. Since the start of this bull market, it's been one heck of a resilient market. It's been able to deal with almost anything thrown in its face. You've had a couple of panic moments. Monday, off of the tariff news, last August, with the unwind of the carry trade, and then we just continue to set new highs.
That's right. And I think in 2025, a lot of investors thought maybe the playbook would change because we just put 20% years behind us. But I think with January being up 2.7%, and I think these sell-offs being bought, it does feel like the same market that we had last year.
What are you worried about?
Well, I'm worried about sentiment becoming too bullish, but actually
Too bullish?
But it's turned the other way. You know, sentiment actually has weakened pretty meaningfully. And I'd worry about a policy error from the Fed. And as you know, the bond market still thinks there's more than a 20% chance the Fed hikes this year. I think it would be obviously a policy error if they raise rates.
What about a policy error from the White House?
That's also something markets worry about, yes. But so far, I would say that the news that we've seen on tariffs, they've had more bark than bite, meaning they've proven to be opportunities for investors to buy.
What would you buy?
Well, the big news this week in our minds is the ISM moved back above 50. That really does point to earnings dispersion improving. So I like industrials, the financials. I mean, the small caps, which have been, not a great outperformer yet, but we still think small caps are going to do well this year.
And what happens if some of the uncertainty around D.C. and policy has a more negative impact on not only sentiment, but actual transactions? I saw a stat today that M&A is off to an incredibly slow start this year, when part of the narrative coming into this year was animal spirits. Can't tell you how many times I heard that phrase over the last 3, 4, 5 months. And What if we don't get that?
I mean, it's still too early, right, because we're only 1 month into the year. The recovery in optimism, both in the NFIB and even the ISMs, I do think it would sort of argue CEO confidence should be better. So I would expect M&A.
We had all but one of the mega caps report. We got to wait a couple more weeks for NVIDIA. What's your takeaway?
Well, it's been a good earnings season so far. The Mag 7 as a group hasn't been great. In fact, they've been a drag on the S&P this year. So part of it is it's telling me I think a lot of good news is baked into some of these names, and especially with CapEx going up. But it doesn't mean I don't think they're market performers. I just think the outperformance this year comes from financials, small caps, industrials.
Canaccord Genuity today on the Mag 7. We think it's fair to say this has been the softest quarter for this group collectively in the last few years. Is that a meaningful softness, that maybe the best times for a while are behind it?
Well, and that's a relative term, right? Because on an absolute basis, these companies are growing far faster than the S&P. But from a what's priced into the stocks, clearly it wasn't a market surprise. That's why year to date they haven't been great.
What about you're paying up, in some respects for declining revenue growth, especially in key areas like cloud for some of these players where that's an essential part of why you were willing to pay up in the first place? Does that matter?
Well, these are secular stories. So to me, stocks might actually underreact to earnings and they might overreact to earnings over time, and they may consolidate for several years. But to me, the key drivers for why you want to own the Mag 7 haven't changed.
Seems like these names have sort of separated themselves from each other. If you look at a chart, for example, of Meta, it's been magnificent. It's like the magnificent one.